Hello, everyone. Welcome back to Capital Consumption Theory. I'm Eddie Chu, and this is um, Brian and Zach, Brian Winters and Zach Widmer. And today we are going to talk about monetary policy transmission channels. So today we have an article on the Federal Reserve website about monetary policy. What are its goals, and how does it work? And I've outlined a little segment here. So it says, in the broadest terms, monetary policy works by spurring or restraining growth of overall demand for goods and services in the economy. When overall demand slows relative to the economy's capacity to produce goods and services, unemployment tends to rise and inflation tends to decline. The FOMC can help stabilize the economy in the face of these developments by stimulating overall demand through an easing of monetary policy that lowers interest rates. So one thing I want to point out here is that um, is this portion here about when overall demand slows, unemployment tends to rise and inflation tends to decline. And this is a little bit sort of like the one-dimensional model that we've talked about before, where often the economy is viewed as if it overheats, you get deflation, and if it gets too cold, then you have unemployment. Um, and this is only true on a short-term basis. It's not true on a long-term basis. Um, I was actually reading Greg Mancu's economics textbook yesterday because I've decided to sort of work on which parts of it are incorrect that we need to correct everybody about. But on our previous episode about inflation and unemployment, Brian was there, and we've talked about this before. So if you look at unemployment and inflation, in the short-term basis, like when you have a recession, you tend to have inflation go down, and you tend to have unemployment go up. So in these gray areas, this is inflation. You'll see during a recession, inflation tends to go down, and of course, unemployment goes up. But on a longer-term basis, the inflation and unemployment are pretty much unrelated. They have almost nothing to do with each other. Long term, 1950 to 2020, this 70 years, unemployment basically just trends around 3 to 8%, and then inflation, on the other hand, has sort of this huge hump in the 70s, and then comes down and never goes back up. So unemployment and inflation are related in the short term, but in the long term, they're really not.
So this kind of reminds me of what Britain tried to do after World War One, and to try and keep inflation in check and get back on the gold standard and everything. So they cut their spending and threw a whole
Yep.
bunch of people out of work. And then when people are out of work and unemployed, they don't have any money to buy things, and so
Right.
that kept the check on inflation.
Yeah. I mean, so in a short-term basis, it works a bit, but on a longer-term basis and for larger movements, it doesn't work. So, in the 70s, when inflation was high and rising from the 60s to the 70s, you had multiple recessions and multiple spikes in unemployment, and yet you still had rising inflation the whole time. And you actually had unemployment going up also sort of at the same time in the 70s. Um, but yeah, that's that. But to get back to monetary policy, so and particular the transmission mechanism. So monetary policy, we're saying that the ultimate effect that we're going for at the Federal Reserve is to spur or restrain growth in overall demand. So this goes back to Keynesianism a little bit, the idea of demand management, the idea that overall demand, aggregate demand of the economy is not self-correcting. It needs to be managed. You need to, you can get into a downturn where you don't have as much demand as you need and as much demand as is optimal in the economy. And then the Keynesian idea is use monetary policy and fiscal policy to add more demand in to stimulate the economy when it's sort of too cold. And the sort of classic, the standard way um, in which that works, the standard way, the way that you'll read in economics textbooks is that when interest rates go down, you know, businesses find it more profitable to invest. So when they're considering to make an investment, they may need some capital to do that. They may borrow some of that capital, and so if interest rates are cheaper, then that capital is cheaper and they're more incentivized to invest. So that investment spurs demand in the economy. That's sort of the standard idea. Um, we're in this article we're also seeing asset prices, so this is important. We'll talk about that later. Exchange rates have some effect, but I think we won't talk about that too much today. And expectations of households and businesses. um, I think this is also interesting because it goes back to, again, to the paradox of thrift a little bit, which I think the Keynes's paradox of thrift is a good description of what happens in a recession. So in a recession, businesses and households basically all get a little bit scared to spend for the moment. They all pull back on spending a little bit, and that generates the recession. So that is based on expectations. Like if businesses and households are worried about the economic outlook, then they will tend to pull back on their spending, and that's a little bit like um, self-fulfilling. Like you'll get a recession based on that pullback in spending. So that is the basic story from the Federal Reserve. Let's talk about this now from the capital consumption view. So one of the things from the capital consumption view is as we mentioned, the paradox of thrift really explains short-term recessions, but there is a longer term shift in the economy that occurs um, that occurred in the Great Depression and is occurring now, where you have a structural problem. It is a problem of wealth inequality, basically, and it is a problem of basically, um, too much income going to capitalists at the top and too little going to the worker consumer um, at the bottom. And the worker consumer is the one that generates most of the consumption in the economy. The capitalist is the one that invests and is responsible for most of the productive capacity, the productive capital in the economy. So when the consumption is too low relative to that, then you get into a situation where you're underutilizing capital and you're underutilizing labor also, in terms of low wages. And at the very end, you start to get unemployment. And this is a structural problem. It's not psychological. It is not a problem. It's not a situation where the consumer worker having not enough income can simply, if you sort of talk him up and he becomes more confident, um, no matter how confident he is, he cannot spend income that he doesn't actually have. So he's limited in his spending by the income. And this is empirically, by the data, this is true also. So if you look at recent surveys, I've heard ones from like 40% to 70% of households could not afford like a $400 or a $1,000 emergency. So basically, the bottom half of the economy, they're already spending their entire income. They have no savings. So it doesn't matter how confident they are, they can't spend savings that they don't have. They can't spend income that they don't have. So you actually end up with a structural problem. And so what you're saying with the Federal Reserve is that this monetary policy that they're doing, it they sort of can keep extending it and keep extending it, and it's not just um, the standard um, transmission channel where you're encouraging investment. There's also a large part, a large and getting larger part of the transmission, which occurs through asset prices. So when your interest rates are down and you keep them down for a long time, that works into financial assets. Um, you know, uh, when investors, fundamental investors, people like Warren Buffett, basically the entire finance industry, when they do a fundamental analysis of a stock as a security, um, they are going to discount the future cash flows of that stock based on some discount rate, and the discount rate is usually based, for example, Warren Buffett uses the 10-year Treasury rate. So if you're keeping your interest rates very far down, then your discount rate is going to tend to go down also. So your asset prices are going to become more inflated. I'd argue that this is sort of a wonky, unstable quasi UBI. Like we've already reached sort of somewhat extreme levels of this, and you're seeing like weird stuff in the market with as we've talked about with in our meme economy episode. You're seeing weird stuff with like GameStop and AMC, meme stocks, Dogecoin, and even cryptocurrencies to some degree, where the asset prices are just really coming unanchored, and this is related to some degree to the discount rate being held down very close to zero. And one of the effects of this is that owners of these assets, including the meme stocks and Dogecoin and Bitcoin, they end up with sort of like a quasi monetary asset. It's a financial asset, but they can by converting it to money and then spending it, they can spend it almost as if it were money. So if you imagine 10 years ago, Bitcoin, the whole Bitcoin supply, um, some of it was still locked up, but even if it's locked up, even if it was not locked up, the Bitcoin price was at 10 cents at one point, or dollar, and the whole market cap for Bitcoin was sort of in the billions or such. This year the market cap is up to $1 or $2 trillion. So $1 or $2 trillion in Bitcoin, that's not US dollars. In most places, they cannot spend it directly, but any Bitcoin owner who wants to spend that Bitcoin, they can do it by converting to US dollars and then spending the dollars. So in a very real sense, they're affected by sort of like the wealth effect. So you know, there is $2 trillion, $1 to $2 trillion of net worth existing in the economy, this year, which did not exist 3 years ago, and it was not created directly by the Fed, but it was created indirectly by the market's reaction to the Fed policies. I think you're on mute, Brian. I think you're talking, but you're on mute.
I am. Okay. So when you say this $1 or $2 trillion has been created, Like it hasn't
Yep.
changed the amount of US dollars that are in circulation.
Yes.
Like I'm all right. So my kids used to play Pokemon, which
Yep.
this trading card game, and like some of these cards are valuable um,
Yes.
because they're artificially scarce. But
Right.
if somebody has a big collection, if they print more of these rare Pokemons or something, does it actually increase the amount of wealth in this country? Because you can't, just like Bitcoin, you got to trade it into dollars pretty much to do
Yep.
anything.
It does absolutely increase the amount of monetary wealth in the economy. So there's many different definitions of wealth, but here let's talk about monetary wealth. So monetary wealth, and if you look at including in the all the old economics models, the standard economics models, um, people earn money and then to some degree they save that money. So they may save money because they want to fund, future consumption. Is the basic idea. So if they save up, $100,000, then they have $100,000 of wealth. Um, but let's take this analogy really far out and say they buy a Pokemon card, a house and a Bitcoin, and let's say they did it. The house was like 50 years ago. They spent $1,000 on the house. The Pokemon was like 10 cents, and the Bitcoin was 10 cents. Okay, fast forward 10 years or something, and the Bitcoin is 50,000. The house is 300,000, 500,000, and the Pokemon card is, I have no idea what they go for. Let's say they're $10,000 now. um, you still have the same number of US dollars in the economy, but you also have this quasi savings vehicle, which is a Pokemon card, which is worth $10,000 on the market. It can be converted to $10,000, just like you can convert dollars to other dollars, or like checking accounts can be converted to dollars. And checking accounts are actually not dollars. Also, they're actually promises for dollars. Your house, it used to be just 10,000, and now it's like 500,000. There's been a $450,000 increase in the monetary value of that house, and that is real net wealth. You can sell the house and spend the money, or you can borrow against the house and spend the money that way. Also, same thing with Bitcoin. All of these things are um, these financial assets whose value has simply like been blown up by the market. And as we've talked about before a little bit, this is to some degree just a matter of the psychology of the buyer and the seller. Like, it doesn't necessarily mean that the whole world wants Pokemon. It might just mean that some people want Pokemon, but the sellers are really, really confident, and that in every single one of them says, $10,000, not one penny less. And so, if they are that confident, then on the market, then that's what it goes for. As long as there's at least some people who still want it. So the market price has blown up these financial assets, and as a result, in your economy, you have this net wealth, this quasi savings, and it can absolutely be spent. Um, and you might wonder how that affects the money supply directly, or the money, like there's a classic equation, which is that what is it? P equals MV. P equals MV. The production is equal to the money supply times the velocity of money, right? Um, so whatever your money supply is, multiplied by whatever the turnover of that money supply is, however fast that money supply is circulating around in the economy, that is equal to how much is being produced, right? That is equal to how much is being produced, because every time you spend the money on goods and services, then That's it's goods and services. Now you have the Bitcoin and the house and the Pokemon card. Whenever this owner wants to spend that wealth that he has, he might sell like a tenth of his Bitcoin. He suddenly has access to money, and then he would immediately spend that money out. So he himself, the holding period of that money for him would be, close to zero. It would be close to zero. And the holding period is the inverse of the velocity. So what you end up with is basically that by owning a Bitcoin, which the market consensus considers to be worth $50,000, he has the right to spend the dollars. Um, do you understand what I'm saying? He has the right he can go onto the market for Bitcoin, access dollars immediately, and spend them immediately. So he has the right to spend dollars even though he does not hold the dollars. He holds something else which the market values, in terms of a certain number of dollars, like say $50,000.
It's like potential energy and kinetic energy in physics. He
Right.
has the
So
potential to use it.
yeah, he has the potential to use it. He absolutely can do it. And when he does that, then what that does is it does not increase the actual money supply, but it does increase the money velocity. He has the right to sort of withdraw $50,000 US dollars from somewhere in the economy. It doesn't matter where. Whoever is going to buy his Bitcoin, um, and then turn it into goods and services. Pass it on.
So this, trillions of dollars in Bitcoin market cap, that can cause inflation?
Yeah, potentially that can cause inflation. I've pointed out before that in both Weimar and in Zimbabwe, the beginning of the last sort of death spiral of inflation coincided in both cases with a crash in asset prices. Stock prices actually crashed as the inflation was beginning to rise. After that, the inflation continued. The stock market on nominal terms actually recovered. Um, and my interpretation of that, because I've thought quite a bit about the dynamics of how that works, is that to some degree, this may be reflective of people sort of withdrawing from the stocks, but then it's a situation where they don't want to be in the currency either. And so they sell their stocks and they get currency, but they get rid of the currency right away. They spend it on something.
So, sorry,
So the
when you said the
the
stock market
asset prices
nominally
actually turn
resolved,
into turn
recovered,
into spending.
when you said the stock market recovered nominally, what exactly did you mean? You mean it recovered in inflation adjusted dollars or in?
And nominal and not nominally based in the currency which was heavily devaluing. So in the native currency, in Weimar, in the native Deutschmark, the stock market crashed as inflation was beginning. At the very end, the very last bout of inflation was beginning, and then it recovered, and then it went upwards, and it just it skyrocketed from there in nominal terms because the currency was actually losing value. It, it's
Okay.
sort of like they
So it didn't
figured out that
recover in real dollars. It recovered in
yeah, it didn't.
okay.
Well, I mean, it sort of held value, in the end,
Okay.
in real terms because it's ownership in a business. So
Okay.
yeah, it's a little bit like they sort of panicked out of the assets, out of the stocks, but then after a few months they realized, wait a second, with all this inflation, the companies are inflation hedge, and then they got back in, and then from there it went in the direction it was supposed to go. But it's interesting to me that in both instances it crashed because that my initial guess would have been that inflation would cause the stock market to go up because it's an inflation hedge. But in both cases, the first thing that happened in the very early stages was that it crashed. So that is my interpretation, is that some of that asset bubble actually fed the like a spike in spending, which drove the inflation to some degree.
Okay, so you're saying everybody pulled their money out of the stock market and then they went out and spent it on other things which drove inflation?
Yeah,
Okay,
yeah,
that sounds,
yeah, absolutely.
that sort of makes sense.
I mean, they were scared about inflation, and they did realize that. I think they did feel comfortable, like in sort of real stuff, like houses, and I think at that time, like sort of like pianos and furnitures, like that was relatively valuable in that economy, and there was a lot of sort of trade in that type of stuff.
So are people cashing out of Bitcoin to buy used vehicles? Is that why the price of used vehicles is
No,
so
not really.
critical to
According to the Fed, the used vehicles are just, and according to other people I've talked to, the used vehicle prices are simply a reflection of the sellers, like the rental car companies. When the pandemic hit, then they were like, okay, it's everything is down, down, down. We better liquidate some of our, car inventory, or we're gonna have a cash crunch down the road. They did that. Unexpectedly, we recovered much faster than anybody thought. So demand is up again, and now they're in a crunch to get the cars back to
right.
fulfill some of that demand. Lumber is a little bit similar. Like they had, they were a lot of the lumber dealers. They were sort of and the suppliers. They were sort of like screwed about in the financial crisis, and so now nowadays they've been very shy about increasing the supply. So that it could be transitory. It's hard to say, but it could also, it's also somewhat worrisome. What worries me more is statements from like Warren Buffett, and there was one other investor who I can never remember his name, and they said the managers are raising their prices, and they're finding, and I've heard this from the ground, on the ground, from friends also. Businesses are raising prices, and they're finding that the buyers are being very accepting of price rises. So to me, that smells a little bit of sort of inflation expectations, like the sellers um, think that the price can go up, and the buyers think that the price going up is sort of normal and acceptable. And if both the buyer and the seller both agree that the price should be going up, then then that's likely what it will do. But I think it's a bit early. I think it's a bit early. I don't think we're sort of there yet.
I think
Um,
for a lot of people, me included, we recognize that the price of labor needs to go up for a lot of people. And so, of course, then the prices are going to reflect the higher labor cost. And so, yeah, if we got to pay more to make sure that people are actually earning enough to survive, then so be it. At least
The
that's
yeah,
my
question
take.
is, are they actually increasing labor? Is there actual costs that go into the price going up? Or is it, hey, everyone thinks the price can go up. I haven't really had any extra cost. It's not adding to my marginal cost per unit, but I'm going to put it up because somebody will pay it, and they do. And
yeah,
I think that's more what Eddie's talking about.
right. And the labor price, labor is a very special thing. It's special for at least two reasons. One is that the labor income goes to the consumer, as income. So the labor, so the entire spending of the economy has to come through labor income in some to some degree. Um, so it has that special function. And the other thing is that labor is relatively inelastic. Like, wages higher, wages lower. Your participation rate, may waver around 60% or 50%, but it's not going to double or half. I mean, 90% of people, um, work and they need to work, and whether they get a lower wage or a higher wage, they're still going to work. They're not going to um, they don't have that option. They're not like a lumber seller who can say, "Oh, this is not a really good price. I think I'll hold back my lumber for next year." Most people just have to work month in, month out. That supply is sort of guaranteed. So it's not a like people.
Well,
I think
but a
way
lot
too
of
many
people
people
are in a situation
worry
right now where they
about
can sort of opt out for a little while, right? If you sold your house, which the asset price, the prices are way up. If you got
yeah,
checks during the pandemic, if
yeah.
you sold your Bitcoin, or whatever, there's a
You could,
lot of ways that
yeah,
people have some extra money right now that are saying, look, I don't want to go back to work unless it's worth my while.
yeah, yeah, yeah. A little bit of that. What is my point? My point is that there is there's a false like wage price spiral inflation narrative
You've
that
somehow
is
muted, Eddie. I'm not sure how, but
out there.
you've muted. It's
Oh,
not on
oh, am I muted?
I can hear him fine.
Zoom. Oh, Brian?
Yeah.
Or Brian says he can hear me.
Oh, I'm sorry. Okay, go ahead.
Yeah, right. Um, right. There's that wage price spiral um, idea that is a driver of inflation, and so people um, you know, I think people worry about wages going up, causing inflation. They do that way too much, and they're not realizing that we are in, wages that have stagnated for 40 years. The wages are way too low. Um, it's not in our situation. It's not going to cause inflation because capacity utilization is really low. So um, the the economists seem to agree that on average roughly like one third of a firm's revenues go to capital and two-thirds go to labor. There's like a sort of an estimate, a rule of thumb that says this. And if you think about it, when you have productive capacity that's very low, like it is right now, and it's 70%, and there's a lot of room, all of that productive capital is sunk cost. It cannot be withdrawn, or it cannot be easily withdrawn. It just sits there idle. So if the capacity is not used, then it is there's no it's all fixed costs. It's all sitting there anyways. So if your labor costs go up, but your capacity utilization is very low, um, you can imagine that the capacity utilization, the capital portion of the cost structure of that firm is actually temporarily zero from where you are until you get to sort of a fuller capacity where you're actually utilizing that capital. You have zero opportunity cost to increasing your volume. So even if your labor costs go up, that firm is still going to have a huge sort of mm, sort of profit margin, ignoring the capital cost because that capital is sunk anyways. And they're not going to be incentivized to raise prices based on higher labor costs. They're going to be incentivized to to allow the demand, the quantity to actually increase. That would be the way that they would maximize their profit and their revenue. Yeah. inflation, capacity constrained inflation doesn't happen unless you get capacity utilization up close to at least 90%. And we're far, far away from that. And I would argue that even if labor costs go up, you still will not see inflation for exactly that reason.
So what do you think of the Federal Reserve, right? They say they're shooting for 3% inflation this year. Does that sound about right?
Um, yeah, it sounds sort of like what I expected. Like I see the Fed as being biased. I see, you guys know that I see the framework as having a conflict that cannot be resolved without basic income, where you're putting money in the top instead of the bottom where it needs to be. So either you're going to end up putting in too little and then the economy crashes, or you're going to end up putting in sort of too much and you might get fairly bad inflation. And I see the Fed biased more towards inflation and away from deflation. And that, what Powell said in was it the last few days, I think, confirmed that. He said, and he's right, the economy is showing many signs of turning up. We've got basically a good recovery. Um, but he's not going to, and we're showing inflation which he thinks is transitory, but he's also cautious not to say that he's certain it's transitory, but he thinks it's transitory. Nevertheless, he's still, it's still on. QE is still on. He's telling investors, don't worry, we're not taking away the QE. If we want to take away the QE, we will tell you well in advance. Don't worry, it's all still there. So, to me, he's still more worried about the downwards than the upwards. So that's what I'm seeing. Yeah. So yeah. So um, yeah. I mean, I'm seeing a little bit. As a trader investor, my two hedged theses on investing right now are real prosperity if we get basic income, or enough support of the right type. Um, or false prosperity, where we sort of continue to blow up these asset bubbles. And, similar to Germany in 1920 and 1921, it can actually be quite effective for a period where it works. The Bitcoiners and the GameStoppers and the AMCers and the stock market in general and the real estate holders and basically anybody who owns anything, is sort of doing great in the last few years. So everybody feels like they have money, because of the low discount rates and the high asset prices. But it's an unstable way to do it. But it can work for a while. It can look like it's working. Um, I mean, it can actually work for a while. The only problem is that it's not um, it's not stable. Like what would be stable is if instead of having these crazy asset prices like GameStop and Dogecoin, and you can imagine how unstable they are and what they could do and the expectations are about them. If instead you just made everyone feel wealthy by putting $1,000 a month in the pocket every month and saying, don't worry, you've got this year, next year, 5 years, 10 years, you're just going to have this for the rest of your life. That would work much better. The other thing is that we had those 3 stimulus payments in the last year, and I think there was like a chart from Larry Summers of all people, which, what I took from that chart was that they worked really well. Like the stimulus payment came in, and the very next month, retail sales like went boom, like a big old bump. And then stimulus payment two, boom, big bump. Number three, boom, big bump. But the next turning point is, and then we're also getting childcare payments now this year, so that'll help a little. Maybe Yang wins in New York, so the UBI is still not, it's certainly not a zero. It's far from a 0% possibility. I mean, it could happen. It could happen, and if it happens early enough, I think we just go straight to real prosperity, and everything will just be great, and it will be amazing. Like people, to some degree, I think economists and people are sort of amazed how well the economy is doing right now, given the pandemic. And I think part of that is that, um, the stimulus payments really, really work. Um, and a lot of economists, they're not taking into account that capacity utilization is at 70%. So if you just give people money and they go out and spend it, your GDP goes up. Employment figures go up. Like everything goes up the way it should. I mean, actually it's sort of actually a simple thing.
Now, I would disagree on one part, and that is
Yeah.
in terms of the prosperity, and it's all great if we got UBI. I
Yeah.
am 100% on the train that UBI would solve 90% of the U.S. economy's problems, but I don't
Yeah.
think that just solving the economy perfectly would lead to a prosperous society. I think there still is work to be done, especially in like the three areas of housing, healthcare, and education, where those three things cause people to not have faith in the real economy, and those things need to be politically solved as well
Yeah.
as fixing the economy.
Yeah. Yeah.
That's my thing.
Absolutely. I mean, I think healthcare, definitely. I think housing and education also, but I think housing and education are also partially caused by the same dynamic, because they're all funded by low interest debt, and they're funded by the system pushing debt into education, debt into housing, and that debt has, I think that's been a little bit very effective at blowing up those two sectors, because um that's very evident that those are two particularly debt um debt enabled sectors, right?
Yes,
Those are classically what you borrow
absolutely.
lots
But
of
there are
money.
still all other problems that are just the debt is trying to band-aid a problem on those things. It's not necessarily causing the problem. Maybe I disagree maybe a little bit with college, but more housing. That one is
Yeah,
the because I
housing.
do think that we can go
Yeah.
into college funding later,
I,
but
I'm not an expert on the nitty gritty details about housing, and sort of like zoning and stuff like that. So I wouldn't, you're probably clearer than I am, how problematic that is. I've read on Twitter about, yeah, I'm not a
zoning
particular
bad.
zoning. Yeah, and zoning may be a
Gotta
great,
be a YIMBY.
but
Yes, in my backyard. Yay, everyone. Yay.
yeah,
Affordable housing. Stop opposing apartments in your neighborhoods. Yeah. Anyway.
yeah. Anyway, so unless you guys have any other closing thoughts, um, thanks for being here, guys, and hope everybody enjoyed this episode of Capital Consumption Theory. Glad that we did manage to talk about monetary policy a little bit, and we'll see everyone next time.
Bye.